Ramesh Iyer, VC and MD, Mahindra Finance, a business that is truly an embodiment of the strength that lies in the rural economy. Ramesh Iyer, who's VC and MD, as I said, joins in right now. Ramesh, it's great to have you on the show. Thanks very much for taking out the time.
Morning.
You've had a dream run in the last 10 years. What kind of growth can we expect over the course of the next 10 years? Because as you know, going forward, it's really going to be the rise of the rural economy, the rise of rural India that will augment the growth that we've seen at a national level with urban India thus far.
So, rural is a very unique place where you need to have unique business model to be successful. And as you know, Mahindra also has this RISE philosophy, which is accept no limits, think alternatively and drive positive change. So that's where we put ourselves in, and this is a business model which has not accepted limits ever. We've always launched new approaches, new products, new processes out there and ensured that everyone is benefited out of that. So if I was to kind of therefore superimpose this in the next 10 years, what would happen to us? I would think it's a phenomenally great opportunity. We are currently in 330,000 villages of this country. We expect that we want to add at least 200,000 more villages to our overall presence. That's one approach that we would look for. I think we ensure that we take the OEMs to the market. We try and expand the market for everyone. We bring in segment of customer, really the financial inclusion story that we have driven. We make sure that we understand customer needs and create product and services that actually customer can meet its expectations. It's a cash flow driven business model. So if I look at all of this, I think if the last 10 years we have had a CAGR of 20% plus, I don't think that should be something that we should worry about going forward. What next? I think the opportunity is extremely large. We are well present there. We are deeper into the market, present every state, working with every segment of customer. So I think it's a great story for us as far as rural growth is concerned.
Morning, normal monsoon and half a dozen states going for elections as well. How much of the bump up usually these two triggers do provide to your business, typically on an average?
So clearly, if you look at monsoon, I think it plays a phenomenally important sentiment role. It's not necessary that everything depends just on monsoon, but if the monsoon is on time, if the monsoon is average plus, I think definitely whatever money that they have stored, they start spending, because then they can restore from what they earn in future. So that's one great story from a sentiment perspective. We've seen both. Couple of years back, we had seen big states not having good monsoons, so how the state suffered, versus last year was a good monsoon. This year is expected to be average plus, so where the market is taking us to. So I think monsoon is important and it does drive positive sentiment. And I would attribute, let's say, if you were to take our tractor recovery or tractor growth, 40% of cash flow, while it comes from non-farm application, 60% farm cash flow does help. So farm cash flow is important. As far as the election and things are concerned, I think we have seen it in many states, how the infrastructure story at state level unfolds and how the labor and asset absorption improves substantially. And when the asset and labor absorption improves, the overall cash flow does go up. So for a business model like ours, both farm and infra cash flows are extremely important. And I've said this before, we've seen all formats. We've seen when both does well, how the market behaves. We've seen one of the two does well, how it behaves, and when both don't do well, how it goes through. So we've had tough 15 months. Now we see both going okay. So I think both are important cash flow as far as farm is concerned, as far as infra is concerned. I think if both of these happen, again, it's a great story to watch out there.
Ramesh, let me ask you this differently. What kind of growth rate are you targeting for AUMs and revenues in FY18 to FY20 over the course of the next 2 years? And what kind of product mix will help you achieve those targets? Because, as you would know, the risk with your business is delinquencies and NPAs, right? So how would you safeguard yourself? What kind of product portfolio would you offer to balance that risk?
So let me kind of start from where you ended. Delinquency is a part of lending business. It's just that you need to recognize what level of delinquency and how does it behave. We have worked with a segment where their cash flows, if it doesn't do well, they do delay payments. I have always said this, please do not look at our NPA as a bad debt. NPA could be high, we make higher provisions, it may hold up at high levels and it come off. But eventually what's a credit loss? So when you have a collateral based lending, I think the collateral has the ability to protect the principal, and therefore the discipline of lending has to be high. When you have an LTV of 75-77% where customer puts in 20-25%, I think the delinquency levels are expected to be low while the NPA may look up. But as far as the overall growth is concerned, we are an enabler, right? We look at every OEM, what's their growth plan. So we started off purely with only Mahindra vehicles maybe 10-15 years back. Today, if you look at our book, 45% is Mahindra and others 55% is non-Mahindra product. While we have a high market share for almost all products that we work with. So I will put all of this together and say our national presence, deeper penetration into the villages, high customer profile segment that we work with, every segment of customer out there, every product that we are currently financing. We are a very strong pre-owned vehicle in the rural market beyond commercial vehicle. We do tractors, UVs, cars, the pre-owned vehicles. So put all of this together. If you have had a, last 15 years, if you have had a CAGR of 25%, the market does give you that opportunity of growth as it expands, and rural is expected to grow going forward. So we are betting on our business model, we are betting on our strategy, we are betting on our penetration, we are betting on our large people strength that we have, 20,000 people spread across the country, 4 million customers we worked with. Put all of this together, and of course adequate investment in technology and people capability. So I think if 15 years has told us 20-25% CAGR, is India going to grow next 15-20 years the same way, and are we going to get the benefit of it? My answer would be yes.
Lastly, Ramesh, have to ask you about asset quality. As we move to now 90 DPD provisioning in March 2018, will it be fair to say that your net NPAs will be similar to what they were end of FY17, or is there going to be a stark improvement, or at least scope for one?
So if you look at 120-day basis, and therefore will there be an improvement? I think the market does give indication that the cash flows are improving. Let's wait till the festival and post-festival when the harvest is out in November, December. Our entire effort, our entire approach, our readiness is to ensure that at 120-day basis can it come down? My answer would be all efforts in that direction. So far as 90 days is concerned, with improved cash flow, will it hold up at 17 levels? Why will we not try for it? But I want to remind again that it doesn't matter to us how the NPA moves up or go down. I think what matters to us is eventually what's the credit loss. You look at historically, we've done some 100-odd portfolios, securitization, and you look at the behavior of those portfolio, and in a period of 3 years time, as the portfolio matures, we have not lost more than maybe 1.5%, max up to 2%. So it doesn't really matter where your NPA numbers look like. What it really matters is how does the customer pay. They are all earn and pay customer, intentionally good, circumstantially difficult sometimes. So I think the business model is around that.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.